Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Paris rapeseed, Winnipeg canola, and Malaysian palm oil markets. I'll start with Paris rapeseed. There are still two key patterns here. The first and large one is the February 2021 to July 2022 ascending broadening wedge pattern. Currently, and wait for the numbers, 728 and a quarter to 982 and a half. This was not a perfect pattern, but it had been the main driver higher in the early part of this year. The break lower in July has left the following incredible targets on the downside. The primary target X is in the 352 area, with a harder to get secondary target X1 in the 217 even area. These are obviously, pretty much way out there targets that you can put into the back of your diary on the back page and look at them maybe once a year. The second smaller pattern was in development until the end of September, and on the surface seemed a more reasonable opportunity. It was created from the break lower of the larger pattern in June and July and is an optimized falling wedge pattern, currently 568 and 3/4 to 606. The key recent feature here have been the temporary halt to the decline at the February low at 599 3/4 back in August, the earlier breakdown through the 50% Fibonacci line of the December 20 to April 2022 move at 644 even, the false break lower 2 weeks ago below the lower trend line, and above all these, the seeming break higher up and out of this falling wedge pattern late last week that has continued until this day, sort of. Now, before I start recapping my previous highlighted possible upside targets for this pattern on the top side, I'd like to reiterate something I've said these past 3 weeks. And that is, there is a key problem with this pattern. It has been created in the wrong place. By that I mean it should have been formed after we've had an ascending pattern, not as in this case a great big gapping drop lower. This has previously led me to suspect that perhaps this pattern may morph further along into something else. So far it hasn't morphed into anything else, hence we still have now a break higher out of this falling wedge pattern, despite today's sharp drop lower. That may lead to these possible two targets. Now I'll give you possible two targets. I'm not saying they happen, not necessarily confirmed about it. A primary target X would be above in the 702 and 3/4 area, and a secondary harder to reach target X1 would be in the 757 even area. Let's just see how these two pan out. Winnipeg canola. Whilst the September 2021 low at 839.20 and the August 2021 low at 817 even both acted to halt the declines back in late June, early July, it was originally the 50% Fibonacci line of the October 2020 to April 2022 move at 863.80 that triggered the retro engines to pull prices up as the market moved on the way down, and then again as recently as late August acting as a cap on the rise. The market over July formed a double bottom but failed to exploit it. However, what has become evident since the start of the sideways to slightly lower movement we've seen here since June is that there's a shallow bear channel, currently 779.10 to 885 even, and that's in operation, and it is this that has been driving the current market. I say that because back in late June we had a dead cross, a lagging indicator, I know and I grant you, but usually still important, of the declining medium moving average, currently at 895.70, down through the declining long moving average, currently 984.80. This should have contributed or even triggered a move lower, and apart from a small move lower at the end of June, in the big scheme of things, it didn't. I also suspect that because the short medium moving average started to flatline and go sideways, that we saw an aggressive move higher last week. Thus, it can be read into the lack of significant action after the dead cross and the flatlining short medium moving average, that the current slightly bearish channel is the main driver lower of this market. Now, until that slightly bearish channel breaks or morphs into another pattern, it will continue to show the slightly bearish angle of attack of this market. We are now 3 weeks into a rally from the regions of the lower bear channel line, and this week significantly this past Tuesday, and to a lesser degree yesterday, we've had a very limited attempt to break that slightly bearish channel, closing for a few days now over the 50% Fibonacci line at 863.80. However, so far it has been a limited breach, with an indecisive doji cross on Tuesday that still closed below the upper bear channel line. I would refer you now to my comments from last week on this matter, and I quote, "Close eye needs to be kept on whether this 50% Fibonacci line is breached, as then the upper bear channel line is in the frame. However, I would be cautious about the seeming lack of integrity of this upper bear channel line, as dropping rapidly into the frame of the market is the medium moving average. That's currently 895.70. And it may be a race as to which gets first to the upper bear channel line." End of quote. This medium moving average could tail the rise on Tuesday and should be reinforcing the upper bear channel line directly by sometime next week, unless something happens to push the market through it. Meanwhile, looking below, as I pointed out last week, and I quote, "One final, though currently distant, thing to bear in mind: the June 2020 to date uptrend, currently at 774.90, is now impinging upon the market from below. The week after next, it will cross over into the bear channel. Just something to bear in mind." End of quote. Well, yeah, I'd say probably next week, maybe the week after. Bursa Malaysia crude palm oil. The move down that finished in July was halted. I have to assume it was halted, as there was nothing else nearby, was halted by the extension of the neckline, currently 38.39, of the September 2015 to November 2017 vintage head and shoulders pattern. After that, prices started a small bull channel higher, verging on being an ascending, expanding wedge pattern that was broken on the downside at the turn of August into September. Now, a few things to remember here. Firstly, we had a significant dead cross of the declining medium moving average, currently at 45.38, moving down through the declining long moving average, currently 5300. You may ask now, did that dead cross provoke a bearish action? Well, not at the time of crossing. But we have seen 2 weeks after that a successful break lower out of the bull channel. Secondly, the short medium moving average, currently 38.63, was thundering lower and still is sort of pressing lower. This appears to be the key resistance, almost a curving downtrend line that has been responsible for pushing prices lower out of the July to early September bull channel. Indeed, its pervasive bearish influence was seen as early as late August, when it capped the market and acted as a proxy for a downtrend. It is still influencing prices today, just a little above the market. This leads to my final point, and one that I have been thinking about now for 2 weeks. Should we regard this broken bull channel as part of another larger pattern? Is it part of a larger May to date bearish halfway hesitation pattern? Or do we regard the action since July to date as part of a possible double bottom pattern? Interesting questions. Whilst we have seen significant moves lower, so far this has not led to the market being either a bearish halfway hesitation or a double bottom. Last week we saw a gapping move lower that tested the important June 21 low at 33.26 and the January 2021 low at 32.50. These two need to be overcome for the idea of a bearish halfway hesitation to thrive. Well, they haven't been. They didn't. But neither did they help the cause of a lopsided double bottom pattern either. It all depends on whether the short medium moving average is broken, not breached, but properly broken. And time is starting to run out. You see, entering in from above, we have the rapidly declining medium moving average, currently 45.38. I reckon we may have between 3 to 4 weeks before this hits the current level. So sorting out of what this market wants needs to be organized before then. Otherwise, the declining medium moving average may well take over the running. Thank you for listening. This weekly broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.